Good morning, and thank you very much for joining us. As I get a little bit older and realize I'm going to have to rely on my investments a bit more, these sort of conversations become far more important. My name is Michael Birch, and I'm a senior advisor at the Family Wealth Advisory Group here at Welch. When we started developing this presentation, the world was very different. I mean, who could have imagined the events that have unfolded in the world and locally with our own sort of coup attempt? And then all of this following up on a 2-year pandemic. I understand it's impossible to predict what's next, but I do think that history is very helpful, and understanding fundamentals also makes it much easier for us to make decisions going forward. Luckily, I'm joined by a very well-educated panel that can make sense of all this. I'd first like to introduce Craig Bassinger. Craig is the Chief Market Strategist at Purpose Investments. He has 25 years of investment experience, combines an education based in both economics and psychology, with years of experience in fundamental and quantitative research. Next, we have Jeff Logan. Jeff is the head of portfolio management of Harness Investment Management and a member of the portfolio management team. Prior to joining Harness, Jeff spent 6 years at Purpose Investments, where he was responsible for developing and maintaining strategic relationships for the firm. Finally, Elliot Bourgeois. Elliot is a manager with the Family Wealth Advisory Group right here at Welch LLP, and he and I work closely together day in and day out. Elliot's a certified financial planner who received his Master of Science and Bachelor of Commerce from Telfer at the University of Ottawa, both in finance, and started working with Welch in 2018. So I'm just going to pass it off to Greg initially, but just before I do that, here's a few house cleaning notes. As you will see in the corner, this webinar is being recorded. We will send the recording out by email by the end of this week. Chat has been disabled. If you have any questions, feel free to send them through the Q&A. If you'd like to have a PowerPoint presentation, if you'd like to have the PowerPoint presentation that Craig's going to share with us, a link will be provided to you to download it, I think in our chat by the marketing team. Now, as anyone who's been with us for some of these webinars, you know that we like to ask a few poll questions as we go along. So I want to kick it off. Now, this is our one and only poll question for this webinar, but what is your current outlook on the 2022 market? Make your choices, please. Optimistic, somewhat pessimistic, or pessimistic. Let's all do that now. And I see that we're shut out from making a vote.
I'm trying to vote right now.
Yeah, no,
I'm not telling what I'm voting though.
Yeah, I hear you. All right, then here we go. Somewhat optimistic, somewhat pessimistic seem to be the majors, but I'm happy to see that there's some optimism and some somewhat optimism in this. That's good to know. All right, with that, I'd like to turn it over to Craig. It's all yours.
Perfect. Thanks, Michael. And
yes.
And as a strange combination might be economics and psychology, but the fact is the markets are behavioral. It's really the aggregate of everybody's behavior that matters out there. And much what you also learn in behavioral finance as well is that when you do polls and surveys, people automatically aggregate down to the middle because nobody wants to be sitting on either end. So
yep.
It is good practice to have 4 answers, because otherwise everybody will simply pick the middle
number
one.
2. Yeah, gotcha.
Yeah, that's but yeah, it's I'll be honest, it's been possibly one of the most news-filled years to start. This year has started off with obviously on a bit of a shaky footing, so I'm going to do my best to sort of share our views on what we think. And again, you know, we're not political strategists, we're not military strategists. I leave that to my brother who's with the forces. So in fact, living in Ottawa as well. So but we do focus really what a lot of these macro factors, macro trends mean for portfolios, for wealth, for equity markets and for bond markets. So hopefully I'll be able to shed a little bit of light on sort of what's going on out there from a market perspective, and I'll sort of share what we expect going forward as well. If I can get one quick thumbs up that people can see the screen. Perfect. So yeah, this is the year that everything changed, and I'll touch on what that actually means shortly. This is our disclaimer. You can pause and read at your own leisure if you like. It's not that great of a read, but so here we go. 2021, last year. Let's go back to the good times. We'll start there. Last year, obviously the markets, especially North American markets, had a stellar year. In fact, any period of weakness was short, fleeting. Honestly, you'd walk away from your screen during a period of when the market would be wobbling a little bit. You'd come back and boom, the market would be making a new all-time high. We wrote a number of times like, enjoy this, because obviously it's not going to last forever. But it was really just a great combination of a number of factors, both stimulus, not that the pandemic was ending, but the market impact of the pandemic was ending, and I'll sort of differentiate those two. And you had sort of strong earnings growth, strong growth. It was really just like a relatively good environment to be investing in. And as we sort of rolled into 2022, a number of big things were changing, and we knew a number of big things were going to change this year. And we talked a lot about them even in December and November, because we started to sort of see where some of these macro trends were going to start to adjust, pivot, and pivoting's hard. When the market goes through a pivot, whether it's interest rates, whether it's central banks, whether it's the economy, it causes uncertainty, and that causes volatility. And usually in our industry, when we say volatility, we really mean weakness, but people like to say volatility nonetheless.
Can I butt in there for a second?
Yeah.
So it would seem to me that individuals in the marketplace that are invested and don't have a sort of a good background like you might jump off the fence a little quicker than maybe an institutional investor that has been down these roads before. Is that safe to say?
Yeah, I mean, I'll be honest. I think one of our industry has two focuses in my mind. One is to build like really well constructed portfolios that are well diversified from a number of different levels, that are more resilient depending on what's going on, and then also tilt them to sort of be better positioned for what we think is coming next. That's part of what our industry does. The other part that's actually equally as important is actually, I think, helping people avoid making those behavioral mistakes, because there is no question, it is stacked against you from a behavioral perspective to be a good investor. If you watch the news, we all kind of watch the news. It's not the news's fault, but they will highlight the most inflammatory, exaggerated component of any story because it's more interesting. It attracts eyeballs, and they're in the business of eyeballs. I mean, in the long term. So, and that exacerbates the way people feel, and it exacerbates the way their emotions run. And when your emotions get elevated, it just makes it a lot easier to sort of lose sight of the long term and make those behavioral mistakes. And a great example is, since the tanks crossed the border in the Ukraine, the S&P 500 is up 4%, right? And that doesn't add up.
Yeah.
But if you immediately saw that and hit the sell button and said, "That's it, I want out of the market. War is not good," that's obviously an overreaction potentially from a market perspective. I'm not saying it's not, but so I think that's I think one of the big jobs in all of our industry, and that's what we try and do as well, is try and shed some light on it, put things into perspective, not tell a flamboyant story. And that's what we're going to do today. So sorry, it's not going to be as exciting as the news. That's all, but I'll do my best. But yeah, like, this year, again, started off in a correction. We are in a correction. The volatility has been elevated. We have seen market weakness. And it started before the conflict in the Ukraine really intensified, from sort of tensions to war. And it was rooted in a number of factors. It's been rooted in the fact that bond yields continue to rise. We are about to see central banks, and the Canadian central banks has already started, but we're starting to see central banks around the world start to raise overnight interest rates. We've got an environment that had extremely strong returns in a number of different areas over the last year and a half that pushed valuations pretty high. And you sort of put all those together, and you've had this bit of, a rocky start to the year. Now, I'm just sort of showing this chart on the right, and really what we're trying to show here is that this weakness did kind of start in certain areas. It started with the NASDAQ, which is very growth focused. It started with the Russell 2K, that's R2K. My apologies for using some industry acronyms, but that's smaller cap companies in the US. And really the weakness started there first, and then it sort of spread to the NASDAQ 100, which is the larger cap companies. That's, there you get more influenced by your Apples, your Microsofts, your Googles, or Alphabets, Teslas. And then it started to spread to the US market, which is very growth focused. And then it started to spread sort of to the TSX to a little bit, but more so to Europe. And it's sort of been going through this cascading factor, creating this bit of market correction. And even though it might have been timed with the war, it was really, I think, building for probably a month and a half because of some of these big things that are changing. And, I think that's just leading from a very calm market to a bumpier one as we move through 2022. So what are these things that are changing? So one is the pandemic. And again, as I have promised, I am not forecasting the end of it, how it's going to work out. I've clearly demonstrated I am terrible at that. One of my team members joined us in May of 2020, and he asked me in April of 2020, because he was living in Calgary, hey, we're not in the office anymore. Should I still come out and move my wife and my dog from Calgary to Toronto? And I'm like, of course, we'll be back in by the summer. And that wasn't last summer. I think it was the summer. Anyway, we're losing track.
I think my wife's doctor told her the same thing. Oh, this will be done in a few months. Don't worry about it.
It'll pass. Anyway, so here we are, clearly not being able to forecast pandemic. But there is something that we can forecast, as with my background, and that's the behavior of people and the behavior of the economy. And that is changing. Whether there's another wave coming, whatever we're going to call it, regardless of that, the behaviors have changed, and the behaviors are changing back to some sort of closer to what they used to be and less of what they were during sort of the harder period of the pandemic. And why that matters is because our behaviors during this pandemic have really changed the markets and have really changed the economy. And so if you can just bear with me here, we all of a sudden stopped going out to eat. And when I say stopped, I mean, we didn't stop, but dramatically slowed down. And this is on a global level. We reduced how much we go out to eat. We reduced our travel. We reduced spending on services. And instead, many of us still with incomes, the majority of us, we went out and bought stuff. We bought houses. Everybody's renovated every part of their house they probably can imagine. If they haven't gotten to it by now, it's time to fess up. You're just not going to do it. People have bought cars, RVs. People have spent money on Apple, my new iPad and my new iPhones over there, and my home desk that goes up and down. I mean, we've just spent money on stuff. We stopped spending money on services. We stopped spending money on a pint of beer on the patio, and we went out and we bought stuff to make our home environment better for us and more livable. Now, that had a couple of different impacts. One, that is super good for corporate earnings at the equity index level. Like if you look at how the S&P or the TSX is composed, the companies in it, that kind of spending on goods versus services is super positive for earnings. And top it all off, a whole bunch of us were bored, so more investors have been getting into the market. So you put those two things together, you've had supercharged earnings because of our changed behaviors, and you've had more and more money because people are bored piling into the markets. And it's no wonder that we had this material rebound in the equity markets. At the same time, a huge spike in earnings growth in the earnings of the market, so much so that it's now a higher percentage of corporate earnings. And when we say corporate or economic earnings, we mean everybody. And the crux of it is, if you go out and you buy an iPad, it's better for the stock market than if you go out and you buy a pizza or buy a beer. One hits the stock market, the other doesn't. And that's the difference here. And that's why these markets have been so resilient, so strong, and have had such a good sort of 24 months up until this recent period of weakness. But now those behaviors are starting to change. And even if it's good for the overall economy, I mean, if we're spending on goods versus services, it's still, from an economic perspective, it's fine. But from a market perspective, that is not a good sign. And we're already starting to see that. Home Depot had a great quarter. They said people are slowing down on their renovations, and the company fell materially. John Deere, the same thing. So we're starting to see it in different pockets. So that's one of the big things that's kind of changing. And I think that has some big ramifications for 2022 and beyond. The other is this global tightening cycle. The markets have become somewhat addicted to stimulus. And this chart on the top right, it's got a lot of squiggly lines on it, and it's very Christmassy colored. But essentially, if it's green, there is stimulus coming off the US central bank, whether it's the US central bank or it's fiscal spending. And if it's red, the stimulus is being removed. And this isn't being necessarily added or removed, it's the rate of change. And that's why you see this big, portion of red shortly after this spike during the depths of the pandemic. And that's because basically we went from, let's call it ludicrous stimulus to just really high stimulus, but the rate of change was negative. But nonetheless, whenever this has slowed down, we've seen the market wobble. And I think the path forward is for this stimulus to slow. And that's what we're starting to see. And we saw the Bank of Canada raise its overnight rate. We've seen the Bank of Canada stop its bond buying purchases. The Bank of Canada is important, but it pales in comparison to sort of the bigger central banks, whether it's the ECB or the Fed, but they're all kind of on the same path at different speeds. The stimulus is being gradually removed, as it should, because the economy is growing really well. We've already got inflation, but nonetheless, that's the path going forward. Another big macro trend that is changing this year. Now, we've also got growth decelerating. So this chart on the bottom is just global GDP. You can see recession in 2020, big rebound in 2021. And now what we're starting to see is this growth pace is starting to slow. Perfectly natural, nothing to get overly alarmed about because we're starting from such a high level. But you put decelerating growth, changes in people's behavior, the removal of stimulus, you've got a lot of weird moving parts here that I think are just going to continue to lead to volatility and, both up and down. But we're starting off with a bit of sort of market weakness and or correction. So what does it mean for the markets? I mean, these are kind of big trends, but one thing is, growth. And when we say growth and value, so just to quickly sort of paint what that is, growth companies are companies that essentially are growing faster. Their earnings are growing faster. It's very dominated by tech, biotech, industrials. Value tend to be companies that tend to be cheaper in the market, but aren't growing as quickly. They tend to be more economically sensitive. Nonetheless, growth. Sorry, good.
Yeah, would you have a couple of examples of growth versus value? So are we talking Tesla versus IBM, something like that?
Yeah, I mean, if you wanted to keep it in, and I mean, Tesla is obviously high growth, but Apple would be in there as well. Microsoft would be in there as well. Google, a lot of the technology companies. But then you have some high growth, consumer companies as well. Obviously, Amazon's in there. So, but it's, companies that essentially are growing at a faster pace than the average within the overall market. And then you've got companies that are call them more established, that are just slower growth. I mean, utilities would fit into there. Telecoms usually fit into there. IBM, it's got some of their own issues, would probably fit into there as well. But nonetheless, yeah, that's sort of the differentiate. And really these kind of two, it's a way to sort of separate the market and look at it from different sort of a different lens or a different perspective, and it kind of matters. And the amazing thing is, for the last 10 years, growth has dominated. And you might think growth usually sounds like it's better because it's growing faster, but they tend to be more expensive, and actually longer term, the returns actually even out between the two different styles. So we've had this 10-year period where growth has dominated for a number of different reasons, because one, they were growing faster when growth was pretty hard to find in the marketplace. Then they were growing faster just because of the technology move towards more and more tech. And then the pandemic hit that sort of supercharged that component, because I mean, if you weren't online shopping before, you sure as heck are now. So that sort of, and all of a sudden everybody needed a laptop, everybody needed home system and technology and Zoom, and so all this sort of supercharged that kind of growth factor after the pandemic hit. But that's starting to fade, and I think it's one, because the interest rates are changing, and two, because of our changing in behavior. And this is sort of where you get into this durable services section as well on the bottom left. And again, this is just sort of where people are spending money. But the fact is, we've started to slow down spending on durable goods, and Home Depot's earnings were a prime example of that. And we're starting to spend more on experiences. Like, I mean, I've gone on vacation on an airplane. I mean, just once now so far, but we like to travel a lot. So, I mean, it's gradually getting back there, and that's changing a lot of the dynamics out there. And I think from that perspective, it's also, a better backdrop for more value companies as well. Now, one of the good news aspects of this is that, when you take that lens and look at broader markets, the fact is the US equity market is tilted more towards growth companies. The Asian market is tilted more towards growth companies. European, more towards value. Canada, more towards value. And that actually sets the stage for a decent market environment for Canada. I mean, obviously, I don't want to say that's evidence so far this year, but because I think this year Canada's benefiting also from having gold and a lot of energy, which is obviously being impacted by the conflict in the Ukraine. But nonetheless, like, we are a value market, and I think that's a good positive aspect for us. And this chart on the bottom right, I mean, it's when you look at sort of things day to day, it's really important to like take a step back and like just really think long term. And the fact is, the US market and the Canadian market tend to go through these cycles where one dominates over the other for an extended period of time. And I don't know if the US domination of the Canadian market on a relative performance basis has ended now. I mean, maybe it has over the last 6 months. But if I were positioning for the next 5, 6, 7, 8 years, I would certainly probably want more in Canada and a little bit less in the US, just based on what we've gone through. And the fact is, this stuff is cyclical, and we've just gone. This has been kind of another tech bubble or super growth period, and I think that just sets the stage a little bit better for Canada going forward. So I do a lot of these sort of client events. In fact, I have 2 more today, and one of the most popular questions all the time is, oh my God, inflation. Oh my God, inflation. Is this the 70s? What does it actually mean? What's it going to do? The cost of energy is going even higher now. That's, obviously that's going to be inflationary. And I think it's a legitimate concern. I would say, and it's interesting because most people who have been in our industry have never actually seen inflation, because again, the last real strong period of inflation was the 1970s. And there's no doubt that the pace of CPI, this is an inflationary environment, and I think it's a greater risk now than we've seen in many years. The question is, where does it go from here? And that's sort of where I'll sort of share my views. So it's really important to sort of break inflation down into sort of the pieces that go into it. And I don't want to mean like the pieces into CPI, which is the consumer price index, the more popular measure of inflation. I want to talk about like what inflation actually means. Like, why is it bad? Why is it good? And the fact is, CPI measures changes in prices, which is kind of inflation. But inflation itself is actually more of a mindset or a behavior. Like, inflation becomes really dangerous when it starts changing our economic behaviors in a material way. And an example would be, okay, let's say I want a new TV. And if I'm sitting there and thinking, hey, I could buy it now, or I could wait 6 months. And if I wait 6 months, it's going to be significantly more expensive. So I'm going to rush out and I'm going to buy it now. That's when inflation starts changing behavior. And I don't want to say like, no, you're not filling up your gas tank right now because the price at the pump spiked higher. I mean, that's a minor change in behavior, but when it starts changing consumption patterns, that's where you have the bigger risk, because that's when people then start to say, hold on, my TV is now costing more. I'm going to demand a raise from my employer, and there's more wage pressures. That's the real dangerous part of inflation, which I don't think we're seeing in a material way just yet. I think what we're seeing is the the remnants of what we've gone through. And yes, everybody, everybody goes back to like, it's a supply chain disruption, and the truckers at the border didn't help here in Canada. And it's been because of COVID in China, and shipping logistics have, caused all this sort of supply disruptions. But, and for sure that's part of it. But the real core of it was our changes in behavior. It was when we went out and stopped buying pizza and started buying iPads, because that, if everybody changes their behavior just a little bit, it disrupts the economic system, because it's, the economic system is dynamic. It can adjust, but it can't adjust that quickly if everybody changes even a little bit. And that's what we're going through. So it's actually more of the changes of demand as much as the supply bottlenecks. Now, there's good news and bad news. The good news is the supply bottlenecks have actually started to come back down. Yes, our blocking the border probably didn't help our situation, but we are seeing semiconductor prices come back down, which is a very good indication of the supply. We are seeing global shipping costs come back down. We are seeing other indicators come back down as well. Now, that's the good side. On the bad side is we are starting to see wage growth and wages tick up. And it's hard to say what that is yet. It's hard to say if that is simply because labor is in such demand and it's harder to find people and nobody's firing people, and it created this sort of strange short-term dynamic, or if it's something that can build upon itself. And I think that's the big question for longer term, whether this becomes a bigger risk in the sort of the number of years ahead. Yep.
So, Greg, if we did decide that we anticipate inflation will be kind of at the rates it's at for the next 2 or 3 years, how does that alter what we should be thinking about with investments and things like that? Or how will it play out?
Well, immediately I need to ask for a raise.
Yes.
So
If it were up to me, you'd have it.
All right, fair enough. There, it's got to be worth something.
Yeah.
But yeah, it's a good question. So if we do get an extended inflationary environment, and that is not our base case, but it certainly does lend itself to higher prices in commodities, which in my mind, I think we've already seen. It lends itself to actually value over growth as well. So it is better for the Canadian market. Like, the fact is, the Canadian equity market, we are value tilted, and we are more tilted towards real assets from an international perspective, and that bodes quite well for us. Australia too. It's just hard to get people to put money all the way over there on their own, but nonetheless. So I think it's leaning a bit more into real assets, leaning a bit more into value, leaning a little bit further away from sort of traditional duration on the bond side, and that kind of mix within a portfolio. And to be fair, like we have a fair bit of those exposures in the portfolios we run now. So it's like, I think we're relatively well positioned for this period of heightened inflation risk. But from my perspective, the way I think this plays out is you have that CPI, that headline CPI number start to come down probably in 2 to 3 months. And I think it's going to come down pretty quickly. And I think some of the bottlenecks are starting to alleviate themselves. And while wage growth is still a bit of a concern, I think longer term, it's probably not showing up in the data just yet because of how the costs flow through. Now, I do also think the high price of oil is probably going to exacerbate parts of this as well, because again, that is inflationary based on everywhere that it goes. But and this is the important aspect. So inflation's really bad if people start to expect it to be lasting a long time, and that doesn't exist yet. And that's our strange chart on the bottom right here. And so what this is, bear with me, there's the nominal bond market. So that's just the normal bond market. How much are yields pricing in? What are yields? 2%, 3% going forward. Then there's the real bond market, which is an inflation adjusted bonds. And the difference between those, you can essentially see what the bond market is pricing in for inflation over the next 10 years, 5 years, whatever you want to look at. You can look at you can slice it up any way you like. But why I'm highlighting that is, if you look at the 1 year, what the bond market's pricing in for inflation, and 1 year, you can call that kind of CPI-ish. But if you look at that number, that's kind of what the bond market is pricing in for inflation over the next year. And as you can see, that's elevated right now, and it's gone way up and it goes way down sometimes, and it moves all over the place. The green and the blue line, the turquoise and the blue line, let's just focus on the turquoise one. That's basically saying how much inflation is the bond market pricing in, not after the next 12 months, but after that point up to 10 years. So even further out on an annualized basis. So call it the average for those 9 years after the first year out to year 10. And what that's showing you is it's actually come down. It's actually been ticking lower. And, you know, essentially what the bond market is saying is that, yes, CPI is high right now. Yes, inflation is high right now, but no, it does not, it's not pricing in this to be a lasting component. So where do we sit on this? And why is that important? The fact is CPI is, or 1 year inflation doesn't really impact asset prices, but that 2 to 10 year number does. And if that actually starts to move up, then asset prices have to move down. If that line starts to move up, your house price has to move down. Like this is the, call it the mathematical piece of the pie that goes into the valuation of assets. And if it's higher, the nominal value of the asset has to go down. That's why that's much more important than sort of the 1 year CPI. And from our perspective,
sorry
yep.
to interrupt there, Craig. I think, and I think that would have been a relief to everybody maybe a week ago, if we would have seen that okay, so this is a transitory inflationary period. We're going to have the same conversation next year, and we're going to see that the CPI is drastically decreased, and that'll be generally good news. There's been a lot of events that have happened in the last year, and as you mentioned, has really put, or last week rather, that's really pushed gas prices up that may affect this. You know, like how is that interplay with the rise in commodity rates that we're seeing going to play into potentially an uptick in that 2 to 10 year line?
Yeah, no, and good question. So, I mean, there's no question the world consumes a lot of oil, call it 90 million barrels a day. It's quite a bit. You know, one of the largest producers is now having trouble moving it for obvious reasons. But it's also worth noting, right? Like you know, oil impacts transportation costs, impacts, you know, consumer cash flow, disposable income. But you know, we're not as dependent on it as we used to be. We're not as dependent on it as we were in the 1970s. It's just the economy has evolved and changed its dynamic. Still matters. The high commodity prices across the board still matter, are still probably an incremental inflationary impulse, certainly in the short term. And their longer term outlook certainly matters as well. But I would also point this out, and you know, we'll be sharing a chart on this at some point in one of our publications. You know, we have never seen a material rise in oil like this that has not been shortly thereafter followed by a material slowdown in overall economic activity, and that's coming. And nobody's talking about it right now, but that is on the horizon. And I think this is going to lead into that. And one of the, and I mean, we can guess about the supply side and whether something gets worked out, or, you know, how it all goes down, you know, over the weeks and months ahead. But the greatest cure for high energy prices is actually high energy prices. And we certainly have that now, because we are starting to see demand destruction, and that's going to sort of create a bit of a natural feedback. Again, everything's all over the place short term right now because it's all new information. People are trying to adjust. There are a whole bunch of unknowns on the sort of logistics and how things are going to work out. But nonetheless, I would, you know, if I had to fast forward 6 months, I'll go out there and say there is almost no chance oil is still above $100. And the reason being, the longer it stays up here, the more demand it actually destroys, because people start changing behaviors and stop doing things, and the economy starts to slow down, and then that actually starts to reduce the demand.
Do you see a price per barrel where it would just completely crash demand, as you're saying? Like, is there, you know, is the 150 per barrel the mark where people aren't flying around anymore because it's absurd to get from place to place?
Yeah, I mean, that's hard to say, right? Like I would say in a normal environment, like I actually think we're already there. I already think we're starting to get demand destruction to a certain degree right now. Probably you might not notice it, but one of the arguments against that is that we've actually saved so much and we have so much more extra disposable income, and that's why sort of this inflationary impulse isn't nearly as negative, and because we actually just have more disposable money because we've been not spending money in a whole bunch of different areas. But nonetheless, I think that's the case for a few and not the aggregate. I think when you put it all together, more money is being spent on energy, less money will be spent in other areas of the economy, and that'll slow things down.
Greg, speaking of spending money, Canadians are spending a fortune on their homes right now. What's the outlook for the Canadian housing market, short term, long term, and what will rising rates do to the demand for housing?
Yeah, I mean, it is really interesting because there is a delayed mechanism from higher yields and overnight rates onto the housing market, and it takes months and quarters before that actually starts to see an impact. But I think that's coming, and the fact is, I think few people would disagree that it is impossible for our houses to be appreciating this quickly. It's simply the fact that more people have money, more people are like living at home, and I mean, we upsized. Like more people are doing that kind of behavior, and it's really changing the dynamic. But again, that's that pandemic behavior that the economy just can't adjust quickly enough, and that's what's leading to let's call it somewhat runaway house prices. And I think as yields sort of pick up, that's going to slow down. At the same time, as our behaviors get back to normal, we're probably going to hopefully stop putting such a premium on where we live and sort of our home environment, and start to go and travel and spend money elsewhere. And I think that's gradually going to get things back to normal. Does that mean the house market's going to, I'm not sure there's a crash or anything, but I think the price of houses has probably gotten ahead of itself, much like we thought the price of the equity market got ahead of itself at the end of last year.
Yeah, and I can only speak for Ottawa, but we have like a 30-year history of 5 3/4 to 6% increase in value of our real estate, and then the last 2 years it's just gone through the roof. Another thing I think might happen, and this is got to do with sort of vacation properties and things like that. So people being unable to travel and all the rest are gobbling up cottages and ski chalets and all the rest like crazy. And then 2 years from now, when they're back to traveling globally, are these things all going to go back on the market at a reduced price? That's going to be interesting to see.
Yeah, no, I think and again, it's sort of just, if almost think of it as like the cash flow of the economy, like more has just been diverted into certain areas than normally would have. And what does that look like when it starts to go in the other direction? So I don't, I think the prices got ahead of themselves, but the real estate market's also stickier prices. Like the equity market gets priced to the millisecond. Real estate doesn't price quite as quickly. So I think that's it will be interesting over the next period.
What's remarkable is that the price of an average house in Guelph, Ontario is higher than an average house in Chicago.
Yeah.
I never would have thought that, right? But our prices are quite a bit higher than the US right now.
Yeah. And I've been to both cities, and I'd rather live in Chicago. Sorry if anybody here on the line's from Guelph. But yeah, so short-term inflation, it probably is transitory. That was kind of the word bantered around quite a bit. Even when it was being talked about, and the central banks don't say transitory anymore, I quickly caution people that when it comes to inflation, transitory is actually probably a few years. But again, we think the headline comes back down, and those inflation expectations might tick up a little bit on the wages, but I think they're probably well contained. So I just wanted to finish on sort of the prepared stuff before we get into more Q&A. But one of the good aspects, though, like even though like we've got these weird changes going on, and it's leading to a bit of a correction now, and it might rebound, and we're probably going to get more up and down kind of environment in the market, because as it wrestles with inflation and the change of central banks and valuations and sort of a slowing economy, and like kind of as the market digests these like big, let's call them big meals, underneath that, like we do have an economy that's actually doing really well. Underneath that, we've got like strong employment gains. We've got businesses reopening. Like it's actually like once you look underneath that, it's a really good story. It's just, yeah, parts of the market might have got too far ahead of itself. The house real estate prices might have got, ran ahead of themselves to a certain degree. So there might be some wobbles and like repricing along the way. But underneath that, like limited risk of recession and an economy that's actually in good shape. And even, the geopolitical issues right now, well, terrible. And my heart goes out to people in the Ukraine. And I think it's deplorable. The fact is, it's also not a big enough part of the economy to actually disrupt the global economy at this point. It might shave a bit of growth off, but it's not that big from an economic perspective. So from that, it is a good environment. And, with limited risk of recession, typically market pullbacks are sort of more opportunities than, a harbinger of something worse to come. And sorry, all this is just, we have a multidisciplinary approach that we sort of look at market cycles in, and this is sort of a lot of the inputs that go into them. And this is just in some of our publications as well, that we sort of share how we view the markets and the health of the market.
So thank you very much for that. That's informative. I think there are some questions out there. You touched on it and we sort of went over it, but this whole Russian-Ukraine, I guess it's the size of the Ukrainian economy and even Russia's for that matter, really don't have a huge effect on the world stage. Is that correct?
Yeah, so like huge impacts on certain industries, like obviously uranium because of Kazakhstan, obviously grain production in the Ukraine, fertilizer in Belarus and Russia, and obviously the big elephant is the energy side.
Yeah.
I mean, those are but those are like sort of narrow industries that have a material impact of what's going on over there and what comes out of that part of the world. But you're right, like from an actual size of the economy, it's just not, could it slow things down enough in Europe? And then that sort of bleeds over to more consumer companies and companies slowing down sales. I mean, it could, but keep in mind, like we're starting from an economy, a global economy that's growing 5%. Like, yeah, like would this be a bigger concern if the global economy was growing at 2% and we all of a sudden had $110 oil? Absolutely. But when you have a global economy growing at 4.5%, 5%, and you get these sort of detractors from growth, it's not as dire a situation from an economic perspective. It still could slow down more, but again, right now, that's a lot of conjecture out sort of a year and a half.
There's a question here that came through that I might ask. With Canadian oil and financials sitting on large cash reserves, do you see a short to medium term trend of consolidation? If yes, how can investors position themselves for such a scenario?
Yeah, I mean, M&A activity has been relatively robust for quite some time, but I'll be honest, like, having cash is one thing, like that's one great ingredient for a more active M&A environment. And to benefit from that, there's a number of different ways you can get exposure to investment banks who actually do the deals, or you can focus at sort of the medium-sized companies that are typically the targets of the larger companies. But I'll tell you what stops M&A activity is uncertainty. And that's probably, we've probably, even though the, balance sheets are healthier, that side of things healthier, the uncertainty is probably trumping that positive benefit on the M&A side. And I would expect M&A probably to slow down this year just with the market volatility, market durations, because again, like it's one thing in a stable market to, strategize, make an acquisition. It's another thing in a market that's moving all around that actually the timing of your acquisition may be ill-timed. And that's how C-suite people lose their jobs.
Indeed.
Greg, let's see, going forward, there's a lot of uncertainty. What markets or sectors would you be looking to avoid going forward?
So from our perspective, so a couple of different areas. One, I think this pullback on the durable spending is a material thing. So I think a lot of the areas that have really benefited a lot over the last 20 months is something that we're probably more shy of. So we are a little bit more defensive in the U.S., away from those growth names, away from the names that have really just crushed it over the last number of years. And don't get me wrong, they're all great companies, but when it comes to investing, there's great companies and then there's the price you pay for them. And the latter tends to matter much more than the former. So from my perspective, backing off a bit on the growth names is still sort of one of the broader trends. And then I think there's a lot of still great opportunities and reasonable valuations in a lot of the service areas, whether that's in the telecom space or other areas. I think that's sort of where more of the economy is starting to pivot. So better place to be.
Certainly felt the reduction in the growth names. There's a homegrown firm here in Ottawa that you may be familiar with that certainly felt the decline in 2022. So.
It's such a I'm not yeah.
And Craig, speaking of Ottawa, the hot topic in Ottawa over the last several weeks has been the trucker blockade. Is there any short-term or long-term impact to the economy in Canada?
Yeah, I mean,
or is it behind us now?
I would say it's probably a little bit of an incremental upward pressure on inflation and the supply chain, bottlenecks to a certain degree. I'm not sure it would turn out to be a more material one other than a brief hiccup from the overall supply chain, because again, a lot of material was actually getting through other, and it's not the Ottawa side, obviously we're talking the bridges now, but a lot of other material was just getting around it. It just took a lot longer and it was just an added expense. I mean, honestly, I think that the ship that jackknifed in the Suez Canal probably had a much more bigger impact than even if our truckers blocked the bridges for another week or two. So, because that had ramifications that are probably still being felt. So, I don't think it was a huge deal.
Do you think it might have a lingering effect in the sense that our stability and our government stability and our ability to handle events that transpire? I mean, I personally don't think I think it'll be forgotten pretty soon, but I just don't know whether other countries will look and say, wow, I used to think you guys are pretty stable. Now I don't know if you're really have your stuff together.
Yeah, it's the old, all the people who moved up here because of Trump are moving back.
Yeah.
Maybe. I mean, obviously we didn't come across in a good light internationally. Is that going to change people's behavior? I don't know. From an investment perspective, I'm not sure it would. We're probably getting more inflows now than ever before, just because of the composition of our market with energy and gold. So,
maybe
great.
Speaking about energy and gold, would a high price of oil is that generally a good thing for Canada? Because clearly there's the Suncor that are producing, and that would help them. But there's a lot of other extractive industries that rely heavily on oil and gas, and then their cost of production go up. So is a high oil price a good thing for the Canadian economy?
Yeah, I mean, we might not be the petro loony we used to be, but 100%, we are viewed as an energy market internationally. And yeah, I mean, that's 100% good for Canada. I'll be honest, yes, mining companies, oil is a big input in their cost chain, but the fact is those commodities are up materially as well. So it's just sort of high across the board and pretty decent for Canada across the board. And but again, it's already there. So that's the other warning, right? I would, when oil is $110, I'd be more inclined to be a seller of oil than a buyer, because you should have been a buyer before. That's the whole trick about investing, right?
I'm still trying to learn that one.
Yeah.
What about the Canadian dollar? Strengthen, weaken?
Yeah, so our view on the Canadian dollar is we kind of view it fundamentally valued between sort of 78 and 82 cents relative to the US dollar. It's been a
Mhm.
really weird environment. Like and when I say it's been weird, it's because like we've had this upward trajectory in the Canadian dollar that you probably haven't noticed nearly as much because the US dollar has been rising as well, because it's a bit of a safe haven currency. So from our perspective, in and around this range, and I can't remember the last time I looked at it, it was 79 and change or somewhere around there. We just view it as relatively neutral. If the Canadian dollar got down to sort of below 78 cents, we'd then view it as sort of a bit of a bargain. And if it got above 82, we view it as overpriced and want to sell Canadian dollars and go more international. And when we're talking about the currency side, we're either doing hedges or we're actually going and just changing our geographic mix a little bit.
So you're keeping pretty busy out there.
It's yeah, this year's been
Wow.
a lot more people want to talk. There's a lot more going on. It's but it's I am impressed with how resilient these markets have been. I'll be honest. I mean, like we just had some phenomenal years and we've got a good economy, which is all great. But if you look at sort of the news that we've absorbed even over the last week, month, these markets are still holding up relatively well, which I think is a pretty good healthy sign for the overall environment. We probably when this year started, we did expect markets to not have kind of the gains they had in the previous years, but actually be probably positive by year end. But we also have published that we think there's probably going to be more than one correction this year. So you can check one off the board because we've been through one. Don't know if it's over or not yet, but it could be. But we think just with what's going on, we just think it's going to be sort of a fair bit more back and forth as sort of the market absorbs these big macro changes.
Another question here about in light of what's going on in Europe and perhaps the instability over there, do you see money flowing here to North America from that? And if so, how will that affect us?
I mean, it already has, right? So that's already been coming in. So the US has been well bid, and that's one of the reasons the US markets actually is up sort of 4 or 5% since the war broke out, is because the money is actually leaving Europe and coming over to the US to a certain degree, and it's a bit of a safe haven currency. And then on the European side, I mean, obviously the geopolitical risk is much more closer there for obvious reasons, but they're also much more tied economically to what goes on in Russia, and I think that's sort of weighing on the European situation. But I think a lot of that's already been priced in. Like, I mean, the European market I think is down 11-12% year to date. The US market's sort of down 7.5%, and the Canadian market, call it down 1 to 2. So I think a lot of that's kind of been factored into these price moves already, and the European market is, like it's cheaper than Canada, it's cheaper than the US. So I think a lot of that's been priced in already.
And it's sort of, we talked a bit about Russia and Ukraine and their oil reserves and their natural gas reserves, and we're talking about a general shift to decarbonization. Do you think this is going to speed that up?
Yeah, I don't know. I've sort of wrestled with that. Like, the manager of our firm's climate fund thinks it will, but I always view them as maybe not objective on that decision.
Yeah.
I mean, certainly certain aspects of it, yes. I think longer term, 100%. Like the greatest thing for clean tech, new energy, whatever you want to call it, renewables, however you want to package it, the greatest benefit for that industry is high oil prices. And that's certainly what we have right now. And uncertain supply, and that's certainly what we have right now. So I think 100% that aspect, yes. But then the question is, like, are subsidies going to be the same? And that's where I think it gets a little bit more difficult, because again, I think people are rethinking their budgets right now. I mean, Germany just announced that they're actually going up to the NATO required defense spending is going to be their new minimum, which is like a pretty big game changer for that country. So, I mean, there's a lot of moving parts right now. I do think like this highlights this does highlight the need to have a much more diversified energy source deck for a country. And I think that's probably the biggest takeaway from this. That is probably positive for renewable, but it's probably positive for nuclear. It might be positive for companies' own extraction of oil and gas, right? Or at least diversifying their sources. So it's hard to say, which one wins. I think it's sort of all the other sources will win to a certain degree.
Yeah, I mean, I think sometimes I'm reading that it's in fact the Europeans' goal to go green and all the rest, and to step back from some of the other sources of fuel and power that's put Putin in a position to sort of grab them by the throat and say, yeah, you need my oil, you need my gas. So that's it would be nice to get green quicker. That's for darn sure.
Yeah, but one thing, and one thing I would point out.
Yep.
An industry that consumes 92 million barrels of oil a day does not change with one small war. Like it literally takes decades for this to even just go a little bit, and then you layer on all the other sources of energy and all the sort of the energy stack, and it's such a massive industry when you look at it across the board. The key is figuring out, like where the pain points are on the supply side, and making sure it's a diverse enough energy basket. And there is no question we are clearly more dependent on the oil side of things, and we need to build up those other pieces of the pie, and that'll probably be positive for renewable energy. But I think the most positive thing is going to be $110 oil and uncertainty.
Taken a little bit of a backseat recently. It used to be very much in vogue and everybody was asking about it, but what are your thoughts now on cryptocurrency going forward?
Yeah, I mean, I think, I think the crypto and the digital currency side is, I think it's very interesting. I think it's gradually growing into a new asset class that could potentially have some better portfolio diversification benefits down the road. But I think right now it is still in that, I like to call it the adolescence phase, where it's doing things that nobody really understands because it's a 17-year-old, and nobody can try and guess what it's going to do next. And I think as it grows and becomes more established, it could potentially be like a more traditional asset class. But right now it's sort of in that high awkward growth stage where it's also running into rising adoption or falling adoption, and gyrations on that side. So I think right now it is a speculative investment. That's all it is. It's not digital gold. It's not a real asset. And don't get me wrong, I own some, and I manage some in a portfolio. So we're not anti, but we just need to understand that it's a growth engine as opposed to anything else or on the speculative side.
Yeah, my wife loves to say, "Show me a Bitcoin."
Yeah,
show me a Bitcoin. Doesn't exist. Anyway, I think we're just about out of time. So thank you very much, Craig and Jeff and Elliot. I think it's been very informative for our participants, and hopefully we'll do it again soon.
Thanks, everybody.
All
Be
right,
safe.
take care. Yeah. Bye-bye.